Along with low costs and low risks, most ETFs are more tax efficient than their costly cousins, mutual funds. But in some cases, ETFs lose their tax advantage and they may end up costing you more in the future. Here's how and why. All investments are subject to capital gains taxes. Capital gains are pretty simple. If you buy a security like a stock and you sell that security for more than you bought it, Uncle Sam's going to want a slice of that. It's important to note that from the perspective of the IRS, ETFs and mutual funds are the same, and therefore they're subject to capital gains tax whenever an investor sells a position that generates a gain. There are long-term capital gains if the security was held for more than a year, and then there are short-term capital gains if it was held for less than a year. Now, the majority of ETFs are more tax efficient than mutual funds because ETFs are able to defer capital gains through a process called creation and redemption. Dave Nottig of ETF Trends says to think about the creation and redemption process as sort of like a washing machine. In this process, the market makers buy and sell the underlying securities to create and redeem shares of ETFs. This is what's important. This does not create a taxable event. Furthermore, ETFs are almost always passively managed. Passive means less trading and thus fewer opportunities to generate any internal taxable gains. However, when investors decide they want more than these vanilla options, complexity follows and ETFs start to become somewhat less tax efficient. For instance, if you hold gold, like the Spider Gold ETF, that's an ETF that tracks the price of gold in London banks, you'll be taxed on the physical gold that's in the vault. Because the IRS views physical gold as a collectible, you're going to get hit with a 28% tax when you sell, no matter how long you hold it, the same as if you held bullion or a mutual fund just tracking gold. ETFs that track illiquid underlying securities like junk bonds or emerging markets may not be able to use that redemption trick I talked about earlier because the fund functions better when redemptions are handled in cash. And ETFs that use derivatives like commodity futures may also be less tax efficient than other ETFs as they get marked to market every year and taxed at a blended rate. You notice this pattern here? When investors move past traditional ETFs to start investing in more complex funds, they may lose key advantages of the ETFs, their tax efficiency. The bottom line is for most investors, it pays to keep it simple.